Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at State Street's enhanced strategic asset allocation model portfolio, and specifically the maximum growth version. Now, name of the portfolio is to provide exposure to global equities by selecting ETFs from State Street and related entities. So let's investigate in terms of how the portfolio has done and how it is constructed. In terms of holdings, we have 11 holdings in here, and these are primarily State Street and SPDR ETFs. The largest allocations are to the MSCI USA Strategic Factor ETF at 21%, followed simply by an S&P 500 ETF, and then an MSCI EAFE Strategic Factors ETF that provides exposure to international equities with a factor tilt. Now, the total cost for this portfolio is 12 basis points, so that's cheap. And the benchmark that we select is simply the MSCI ACWI, given that it's an all equities portfolio. Now, the performance of the current holdings compared to the MSCI ACWI shows that, well, since 2015, this portfolio would have slightly underperformed the MSCI ACWI. Having said this, this is the portfolio performance of the current portfolio, not the track record that likely includes rebalancing at some point. We can go to the fact sheet that Citi provides, and here we see the maximum growth portfolio. So that's the one we're analyzing. And we see that it was only launched in March 2025. So we have less than a year of data. Having said that, in this 8 months or so, this portfolio significantly underperformed its benchmark. So we have 15% for this portfolio versus 19% for its benchmark, which is the MSCI ACWI, and I think like 98% and 2% T-bills. Now that's not great in terms of performance, in terms of track record, right, or the track record of the current portfolio. But let's investigate further how this portfolio is constructed. We can look at a simple sector comparison, and here we see effectively that the one big difference of this portfolio to the MSCI ACWI is an underweight in technology stocks. Now, that might be simply because some of these ETFs in the portfolios have certain tilts, right? They are factor focused, right? So for example, if you think about a bias towards the value factor, that would imply a lower weight to technology companies because they tend to be expensive. We can verify that. And first, we can have a quick look at the underweights to the benchmark index. And indeed, we do see significant underweights to the kind of large tech stocks like NVIDIA, Apple, Microsoft, Amazon, Tesla, and Google. And we can switch the perspective to factors. Now, a returns-based factor exposure analysis will highlight that, yes, it's primarily an equities portfolio, right, with some international exposure, which means you have a negative beta to the US dollar factor, or US dollar index to be precise. We can also look at the betas to popular equity factors. Now, overall, there is a slight bias towards the size factor, a positive one, right? And there are some small cap ETFs in here. There's perhaps a positive exposure to the value factor, but overall the exposure to other factors like momentum, quality, or low volatility is all over the place. Now, it is worth mentioning that if you look at this portfolio from risk perspective, equity factors hardly matter. We can see that almost all of the risk can be simply attributed to the US stock market. Now, that raises the question if this portfolio is constructed thoughtfully. And we can look at a holdings analysis. And what we see over here is the betas to asset classes, as well as the betas to popular equity factors like value, momentum, quality, low volatility, and size. Now, unfortunately, in this portfolio, we do see what we come across quite often, that the funds that are being used here have opposing factor exposures. So for example, we can look at the value factor and we can see a negative beta from this MSCI US Strategic Factor ETF, but then we can see a positive beta from the developed world ex-US ETF. And so effectively what you have happening, in this portfolio is what's called factor netting or factor offsetting, right? That these exposures simply net themselves off. Now, as a result, you simply are left with equity again, right? So this is simply a function of having too many funds in the portfolio that have conflicting factor exposures. Next, we can also ask the question is if the fees of this portfolio can be reduced. And we're simply going to look at if the ETFs used by State Street can be replaced with kind of like passive benchmarks that are also available via ETFs. And so an example of that might be, well, here we have the Spider MSCI Emerging Market ETF, which is charging 31 basis points. But there's a product from BNI Mellon that charges 11 basis points, right? So effectively, you're saving 20 basis points. Now, if we would replace all the holdings of the State Street portfolio, we could effectively reduce fees from 12 basis points to 5 basis points. And what's kind of nice to see is that this cheaper portfolio actually would have also generated a higher return over the last 5 years. So what's not to like? Finally, we're going to see if we can simplify this portfolio. Now, as highlighted earlier, there's 11 funds in here, which for an all equity portfolio is simply too much in the sense that there's not differentiated exposures. Now, here's one version of how to simplify the portfolio. So instead of having 11 securities, you can reduce this to 4 securities, which would be simply the international stocks, US small caps, US value stocks, and then a world index from Vanguard. Now, that fund performance is almost identical, and fees would have been reduced, well, from 12 basis points to 8 basis points. Having said that, so this is a simplification from 11 to 4 securities, but we can simplify this even further simply by, well, buying the MSCI ARPI, given that there's almost no difference. And this kind of concludes our short review of State Street's strategic asset allocation model portfolio, right? And this is the maximum growth version that has these 11 ETFs, right, from State Street, and I think there's a couple of related entity ETFs in here as well, but they have 2% allocation, so they hardly matter. But as we can see, you don't need 11 securities. You can simply buy one, the MSCI ARPI index. You can reduce fees, right? So there is unfortunately nothing special in here. And as we've seen from an actual track record perspective, this portfolio has already underperformed by more than 3% in a very short time frame, which is also not great. Hope that helps. Have a nice day.